Welcome to the VC React podcast. Every week, we bring you insights and reactions from top VCs reacting to weekly news on startups, VC funds, and investment rounds. In today's episode, we will talk about debt funds, growth funds, mobility, EdTech, and we will close with refreshing good news from Palestine. We have a great episode for you today with four fantastic guests. Aboudi Al-Qattan, Principal at Dash Ventures, Faisal Hakki, Managing Director at AB Ventures, Mark Kleyner, Co-founder and CEO at Dream VC, and Tambi Jalouqa, Managing Partner at Propeller. In the video description, you will find more details on our guests, their LinkedIn profiles, and links to their companies' websites. Our weekly news are brought to you by FWDstart, a twice-weekly newsletter that breaks down what's happening in the MENA region, startups, VCs, and tech space. And as always, from FWDstart, we have my co-host, Jamie. What's happening this week, Jamie?
Plenty happening this week, Ahmad. So let's start with the debt, and we'll take it from there. So Ajij Capital and New Capital, they've launched a new 100 million growth debt fund focused on addressing the sort of debt capital gap for Series A to Series C in the region. So it's going to be called Amplify Growth Partners, specifically targeting market standard deals as well. So in contrast to maybe some of the larger debt transactions that sort of popped off back in 2023. So it's looking to invest in companies that have already demonstrated market traction, so are in the scaling phase. So they need to be a couple of criteria. It needs to be VC backed, 5 million or more in revenue, recently raised an equity round, and have a manageable cash burn rate. So in terms of the loans, they start from $3 million with terms of 3 to 4 years. They'll be dispersed in 2 to 3 tranches. Might include a warrant component to align incentives between Amplify and its portfolio companies as well. In terms of funds to date, they have a first deal has already closed. It's a Saudi fintech, hasn't disclosed who that company is. I'm sure someone here probably knows. But
we can guess.
In terms of the fund itself, so it's going to be managed by Sharaf. So he's a veteran, 2 decades of experience in debt and equity investments. So previously he co-led Gulf Capital's 220 million credit fund, established NBK Capital's mezzanine debt fund previously as well. So up to 20% of the fund is going to be allocated to companies outside of the MENA region as well, but who are looking to enter the region. So yeah, it's another fund that complements, obviously, back in May, we had Shrewd Partners launched their own, I think it was 100 million debt fund as well. So they have a strong pipeline coming up.
Thank you, Jamie. Let me start with this. Historically, in the MENA region, the ecosystem was driven by equity investments. Now, as you mentioned, Jamie, we're seeing a surge in debt funding, with also some big VC firms investing in venture debt as well. Why do you think there is this sudden interest in debt financing in the MENA region?
Well, yeah, I mean, I think it's long overdue. If anything, I think this is an absolutely healthy and positive indicator on the maturity of the asset class, the venture capital asset class. So yes, it's definitely a good thing. It is overdue. My only sort of qualification to that statement is that it comes, I want to say, in the absence of other forms of financing that are, that remain absent from the market. Saudi Arabia probably being the exception. And what I'm here referring to is the sort of bridging between private to public companies that is quite underdeveloped across the entire MENA region. Again, Saudi Arabia might be the exception, but then again, Saudi Arabia are doing it in a top-down approach. So it's mostly public spending that is driving the transition of private companies to public companies. So yes, for me, this is beautiful. I mean, this should have happened 10 years ago.
Faisal, let me stay with you. You work at AB Ventures, which is part of a bank. Can you tell us the difference between the VC debt financing, like venture debt or other ways to fund a company in debt instruments? How is it different from a bank financing to companies?
I hate to say this sitting inside the bank, but effectively, bankers have only one job, and that job is to price risk. The difference between a debt fund or a venture debt fund and what a bank does is the way they price risk. So that includes the way they perceive and look and handle risk, and what sort of appetite and capacity they have towards risk. and by extension, the way they price it. So that is essentially the difference. Banks can very easily do venture debt. They very consciously choose not to, because for them, pricing that risk is not something they're comfortable with.
Can I disagree with Faisal?
Please do.
If
I
can.
love disagreements on this podcast.
I think that venture debt, although it is a valid form of financing, I think it shows the lack of Series C and down the line capital. It is becoming the only way that companies at Series B and C sometimes can actually find capital to grow. I think it's dangerous because it depends on the product. Are you taking that cheaper capital and then extending it to your customers, or are you actually building with it? And can you actually maneuver as a company if you took that debt on? It becomes riskier on you. Usually, us investors, although we have the illusion of having control, we don't have control on the companies as much as someone who actually has the company they can literally make them pay back the money. They can push them out of their home in a way, if you think about it, as in dilute everyone in sense. So it's bringing riskier capital into a game that's, like it's a startup already. So they need to be comfortable in doing things. So I'm a little bit wary. It depends. Of course, some companies it will be good for them. A lot of companies, when it's the only option, I think it's dangerous, especially when it's at the seed stage. Seed stage should be normal safe notes and equity rounds from traditional VCs, in my opinion. It shouldn't be debt. They shouldn't be taking on debt, even if it sounds like venture debt. And I would love to hear everyone's opinion. Aboudi.
So I think venture debt and growth equity go hand in hand, right? Those kind of investors target the same asset class, which is companies like Jamie and Faisal were both saying that have reached a certain threshold and that are achieving certain milestones and traction, whether it's a top line number, whether it's profitability. Don't forget, a venture debt company probably wouldn't even look at a seed stage company because there's certain requirements in terms of being able to finance those facilities, right? So I actually really welcome the emergence of venture debt in our region. It's Farouk and this new one aren't actually the first ones, right? There was Shua and PFG have been around for a while. Now, I think a couple of years ago when they were submitting term sheets to startups, they were very archaic and limiting term sheets, a lot of things that you wouldn't want to see if you were an existing cap table investor on an equity startup. But that's how you kind of learn, right? Those guys came to market, tried things out, realized they need to reprice. And now most very recently, we've had a startup engage with PFG and the terms have been substantially better. So for me, the emergence of venture debt in the region signals companies getting beyond the Series A and being able to service debt payments on a regular basis. Now, like Faisal said, this maybe comes at the risk of not enough growth equity, and those things shouldn't be mutually exclusive. You should be able to take venture debt and also take large equity rounds, using them for different things. Right? Typically, if you're in a fintech company and you want to lend, you'll use debt. And if you want to raise equity, you'll use that for CapEx. And that's kind of how those things go. But when I read this article, I was very happy. I feel like it means that there is interest in our region at a later stage. And it means there are startups that have actually accomplished enough to warrant getting venture debt, which wasn't really a thing a couple of years ago. Now, again, that means that to accompany it, we need to have growth equity funds. And I do believe, and I am hearing that they are being set up, but venture debt alone won't drive our innovation the way it should. They have to be both hand in hand.
Okay, so Mark, you have an accelerator for VCs. You train VCs. Let me ask you this. This growth debt fund was started, according to the news, by 2 VC firms. And it's like their debt arm somehow, it seems so. And I know I'm asking for speculation here, but do you think they are acting as LPs themselves, or they brought in outside institutional LPs to back the fund? And did they create this fund to support their own portfolio companies and reduce the effect of dilution on themselves and the founders in the future? What do you think?
I mean, I think it could be both, right? So I think I'll come back to this in just a second. I'm also someone who likes to disagree with people. So I feel like there's merit in everything that's been said so far. On one hand, I think venture debt traditionally is a way for later stage debt investors to feel like they're getting closer to equity financing and to feel like they're getting closer to VC without taking on quite as much risk. Because usually we're still looking at a bit of a balance between the existing equity that's been raised by the startup and the venture debt that they're taking on. I think you see this often as well in the rounds we tend to see, where it's often a relatively large equity position complemented by debt, whereas the debt will still bear priority in the case of anything going wrong. So technically, when a startup is raising both venture debt and equity, the equity investor is potentially exposed to much more risk in the case of liquidation. I think it's not necessarily a bad thing, though, this fund in general. I think it's good. For us, we have a very high risk tolerance because we operate across Africa and the MENA region. And in African markets in general, we tend to see very limited debt. I think it's usually a ratio of 4-to-1 or 5-to-1 of equity to debt financing at the earlier stages through to growth equity. So that does usually mean that debt is only available as a working capital facility. Essentially, let's talk about a big logistics company or a big fintech that is processing transactions and needs a lot of debt. I think we might even touch on one or two of these that might need a lot of debt later on in the conversation. Now, what do I think about them coming into this fund? I think it's quite healthy. I think actually it makes me think a little bit of an example that I assume a number of people in the room will be familiar with, of when Qatar Innovation partnered with African Invest Group a few years ago to launch a fund, when you have two different complementary skill sets. And in that case, that was a strategic fund partnering with a private equity fund. Here we have a private equity fund, or more like a growth debt fund, I'd say, which is not debt, but maybe growth PE, which is what I think of Ajij, and then maybe more early stage VC and tech, which is what I think of Noah. So I think they're likely coming in as anchor LPs, but nothing preventing them from having others come into the fund and maybe just not make the press release announcement, right? So I think that's quite common as well.
Is it typical for a VC fund to invest in a debt fund?
It's not typical, but I think it would make a lot of sense to a number of LPs who maybe are worried about the liquidity of the equity positions the fund is taking. I think, for example, for a fund in the Middle Eastern region, potentially it's starting to change the perception of the extent to which you can get liquidity, but it's still usually a 10 to 15 year picture. So for most LPs who are investing in these funds, they're already coming in and expecting that every fund will ask for an extension, which is when a fund sets itself up for 10, 12 years, but then says we need another one or another two, or a continuation fund or another vehicle. That provides a much more guaranteed level of payout, or at least a much higher likelihood of that payout. I think to a large extent, what I would have loved to see, and this is just me being whimsical because I think this is unlikely to happen very short term, I would have loved to see more revenue-based financing to complement the debt, because I think that revenue-based financing is a bit closer to venture capital than venture debt. And venture debt is a bit more close to growth capital and debt financing at a later stage. But, you know, we're coming at the same picture from two sides.
We have a plethora of revenue-based financing companies in our region, actually. There are a couple that have popped up. We've got one in our portfolio. Flapcap just raised quite a substantial round. So it is a space that's booming a little bit.
Yeah, and that's a good sign, right? I think it's just I'm saying that for me, every time I hear something like that, I feel like, that's exciting, because every VC is going to be knocking on their door. But for that, not every VC, just some VCs.
100%.
Faisal, would you ever consider adding venture debt to your portfolio of services, to companies or your offerings?
That's an excellent question, because I was just about to comment. I'm pretty certain that the guys at Ajij and Noah, when they came up with the idea, what they did is, you know, they had one set of sheets that had the expected IRR for their VC funds, and then another set of sheets that had the expected IRR for the debt fund. Combining those together, I think the numbers look better, not worse. So I think on average, venture debt in our region will actually enhance and improve your return on invested capital. So to answer your question, yes, I would absolutely would like to add. In our case, we're a bit too early to add this as a complementary. Hopefully, when we're doing Series B and C type investment tickets, fingers crossed, that this would make absolute sense.
Okay, Jamie, move us to the next story. What's happening?
Yeah. Let's move on to a growth investment then. So yeah, Jeddah-based Shift, they've secured $83 million in funding from Saudi investment firm MENA Capital. So this is their third growth investment. They invested 40 million into data company Masterworks back in 2022, 30 million into, I'm going to pronounce this incorrectly, someone corrects me, Jisr.
Yeah,
there we go. That'll do.
Yeah,
perfect.
It means
Should have
branch.
asked. I'm going to ask you to edit this out, but just keep it in because it's just funny.
Okay.
So that was in 2023, so that was last year. So the important note, MENA Capital also manage a VC fund that's aimed at sort of the gaming and esports sectors in Saudi as well. So they've about 82 million in capital at their disposal as far as that's concerned. But in terms of Shift, founded back in 2017 by Khaled Al-Suleiman, they provide ton of different mobility solutions, very varied: car rentals, chauffeur-driven services, last mile logistics, group transportation, vehicle leasing, pretty much anything. So they operate a fleet of about 12,000 plus vehicles across 57 cities in Saudi. And they also offer rentals via a mobile app as well on an hourly basis or a daily use too. In terms of the founder himself, he was a board director at Al Suleiman Group. So that's one of the leading conglomerates in Saudi. He's also a board member of the family office of that particular group, Al Suleiman Investments, a tech investor with MENA too. So Shift, like amongst its corporate clients, you can count Amazon, Noon, Aramco, etc.
Thank you, Jamie. And Tambi, I'll start with you this time to ask you for the definition of growth. I know you focus on seed stage, but when do you think a company is in the growth stage? So Mirak is a growth fund investing $80 million in one company. And we have the Amplify Growth Partners Fund that we just talked about, says it's a growth fund, but it invests in series A to C, and the whole fund is $100 million. So what defines a growth stage in MENA for both startups and VC funds?
My assumption would be companies raising tickets of 50 million and above. The whole round should be 50 million or above, or around that. Then that would be a growth fund, to my understanding, which means that Shift falls within that growth stage where it's almost last stage before they start either expanding or aiming for an IPO. I'm not sure.
For a VC fund to be a growth fund, are you saying that their average ticket should be like around $50 million or participating in $50 million rounds? But for them, the funds would be, I don't know, $200, $300 million?
I think it has to be around, usually I guess it's 250 to 500, I'm assuming. And they should be able to write tickets of 30 million plus.
And I think we only have 2 or 3 funds like that in the MENA region.
I think it's dangerous to assign a specific number to what constitutes a growth fund. I think, especially in our region, you have to discount things to what they are in the West. So a growth fund just means a company, or a growth round just means a company's gotten beyond initial product market fit. They're probably operational in 2 or 3 markets. And now they're going to use the funds to sort of like blitz scale. Doesn't mean, spend ridiculously, but it means they figured out how to work with the capital they have. Maybe they've raised a couple of smaller rounds, a $10 million round, a $15 million round, whatever it may be. When you go and you raise growth capital at the Series A or Series B or Series C stages, it just means you've kind of figured out what works. You figured out your marketing campaign, and you're ready to now invest in that growth. So I think assigning a number is a bit of a dangerous game. I will say in regards to Shift, I know we haven't gone to it specifically yet, but one thing that really excited me about this opportunity was when you think about a company that controls the flow of goods and the flow of people in an entire country, the opportunities for data and for route optimization are immense, right? And this then goes into Saudi 2030 vision, because if you know where all the goods are and where all the people are, and you can start bringing in, let's say, green vehicles or electric vehicles, you're now contributing to reduction in traffic, you're contributing to the flow of things throughout the entire country, and you're doing so in an economically friendly way. So while it may seem like this is a mobility play, there's so much more at stake for Shift, and I think it's an extremely, extremely exciting funding round to be announced.
That's amazing. Let me go back to Mark and Faisal. How do you define growth stage? With numbers or without? Is it revenue for startups, for example, or is it the fund size for VC funds?
I would say that it's a discretionary question. I would not say it's a revenue or fund size. I think usually when we talk about funding rounds, for me at the very least, I classify the early stage pre-Series A funding as one territory, the early stage Series A funding as a second territory, and the transition to Series B and beyond as a third. I think even just from a conceptual stage, we call it Series A because we're creating a new class of Series A shares, which is very different from the non-class creating range of preferred shares we have at, you know, the angel stage, the pre-seed stage, the seed bridge, the seed plus, whatever people like to come up with for a lot of different seed rounds at this point. I think Series A usually for me means it's starting to get to a point where we see some repeatability. So I think I agree to an extent, Aboudi, for example, that the company might go for blitz scaling, but it also might go for a slower but more consistent rate of growth in the sense that they found a playbook that works. So for some
100%.
companies, if they're an Uber style or Swivel style, for example, that's when they decide, okay, let's put the kind of foot to the pedal, let's go 100 kilometers an hour. We're going fast. But at the same time, for somebody else, it might be, okay, we've expanded to 4 or 5 markets. Now we're going to go deep into those markets. We're going to have an increased cost of customer acquisition. So we need to really make sure we become market dominating players. Now, when that happens, normally there's a few things that also happens. Suddenly your VC investors are no longer founder friendly. Whatever we define as founder friendly, suddenly people are talking about, okay, we're putting a lot more money on the table. So if we mess this up, I'm going to get fired. At that point, suddenly people start taking it seriously. The questions of governance, questions of, do you have a board of directors? Is it your uncles that are on the board of directors, or is it actually someone independent? These questions all start to become more important. That's number one. Number two, as we usually see in the region, this is when international capital starts really coming into the conversation. So a company could very well go through pre-seed and seed and not have international capital involved, but at growth stage, as you guys have all just highlighted, there's so few funds that are available that actually can participate in the round. So it's very likely either the round is led by or joined by a major international player. And that comes with international expectations. So what you normally see as a VC is that the valuation jumps a lot between the pre-Series A through to the early Series A and the larger Series A rounds. And it's at that Series A inflection that for me, I start to think it's growth. Because for a VC, you might see investments at anywhere from under $1 million valuation through to 10, 20, 30, maybe $40 million valuation of a particular company at the super early stage. But once we're getting and jumping into 100 million valuation, 200 million valuation, for VC funds to see a 10x return, they need to justifiably believe this company is going to exit at a $2 billion valuation. And I can count on one hand the number of companies in the region that have done that. So for every VC there, IC is going to say, what are you doing? Why are you investing in a company that's so expensive when every company comes at a discount because of unfortunately, the region's liquidity constraints? So I think that point when the VCs are starting to say, hold on, this looks like it's growing almost too fast for us to afford it. And when growth equity investors start to say it's appearing on our radar, that's for me that growth transition. Yeah, I guess, as I said, again, coming back, I don't think it's the same point for many companies, because if it's, for example, a deep tech company, it's a company that maybe is doing air purification or is desalinating water or is doing anything in that space. The amount of capital required to get even to Series A, you may be raising your $30th million. But if you're a software business, maybe you're just raising $10 million in your Series A round, and your next round will be 150, right? So I think it's kind of hard to say like, now I've hit growth. I think it's more like a continuum. And when everyone starts to agree, okay, things are really heating up, then I could say we're in growth stage. But sorry, long opinion.
I love that. Faisal.
I would tend to agree with all what was mentioned. I think the definition of growth stage is very much contingent on the nature of the business and the industry and the vertical in which it operates. So you will have quite varying definitions based on who the companies are and what they do. In its most rudimentary form, I think a growth stage company is a company that has figured and nailed its product market fit. They have figured and nailed their business model and revenue model, and they figured and nailed who their audience and how they can scale that audience beyond a certain geography or maybe even a vertical within an industry. If you figured all of that out, then yes, you are by definition growth stage. No more pivots, no more changing in directions. You're probably at EBITDA positive, or you've engineered your EBITDA to be, around zero so that you continue to grow at a hyper level. So all of these are telltale signs of a company that is in growth stage. It doesn't need to be a certain revenue metric per se, because that, like I said, differs between one company or another. I think what Mark mentioned on the scarcity of growth stage investors in the region is also another sign of the nascent nature of the asset class. We haven't been doing this long enough for us to have a lot of growth stage investors. It's only been, I don't know, in certain countries, it hasn't been even 10 years. In the region, I think it's been 25. Jordan might be the oldest country doing this in a consistent manner, at least. So yeah, I mean, give it time, more people will come in and more growth stage investors will come into play. And I would suspect the more successful ones are the ones who have done earlier stage investments. So once you become a growth stage investment, more likely than not, you are a multi-stage investor that has, dipped his toes, her toes in earlier stage investments and built enough, got to do later stage investments. One last thing to mention on Shift, I think we sort of brushed over it. I would suspect, just reading the news, I don't know the particulars. I do know Merak Capital, by the way. They sit on one of the boards that we are investors in as well. My impression is that these are fairly conservative investors. Again, I don't know the deal particulars, but I would suspect that this is asset-backed. So these guys probably own the cars that they operate. So all of that money, or a big chunk of that money, is going towards buying a fleet. So it's de-risked by the nature of what they're using the money for. And B, I would also suspect that a big portion of that money is not equity.
Okay, let's focus more on Shift. They offer a broad range of services, including, as Jamie mentioned, car sharing, rentals, last mile delivery, transportation across borders, leasing, and more. So in other markets, as far as I know, startups tend to focus on just one of these verticals. And we've seen, I think, unicorns who focus on just one vertical of all these. How can Shift manage such a diverse portfolio of mobility solutions and still remain competitive, if they will?
Very valid question, Ahmad. I'll let my fellows answer as well. But if you've been to Saudi Arabia and attempted to ride here anywhere in Riyadh, it's a nightmare. So I think it's only natural that someone comes up with a holistic solution. I'm sort of spitballing here, but I would also suspect that the nature of the way Saudis or people in Saudi Arabia, not necessarily Saudis, think and use mobility solutions is quite different and unique. This looks like 1950s USA, where you have a lot of roads and not a lot of public transportation, and people are not willing to use it for the obvious reasons, whether it's the climate or the culture, any of those, blend of those factors. So yes, it does make sense to have more than one mobility option under a single umbrella.
I mean, I think it's also common when you are solving for a particular problem in a market where you might benefit from a complementary solution being there, but no one's really providing that solution, to at least experiment to see if you can become that provider. I mean, for example, there is a possibility that in providing the range of these solutions that Shift is doing, if it works well, they can spin out some of them and create separate standalone businesses that might have their own growth projection. I think, for example, something to me, just looking from the outside, we're not as active in the Saudi market. I think it's interesting that they have a number of corporate partnerships already. And I think that validation, that means that we're maybe talking about enterprise contracts. We might be talking about at least annual or multi-year agreements that could make or create a bit of a buffer for demand for their solution. And maybe there's scope for them to expand. I think, for example, for me, I'm wondering, with all of the things that they're doing, are they going to need to consistently raise more debt? I think an example that I think of, it's becoming quite well known in Dubai, is Move, which is an example, one of those few rare companies where you see a sub-Saharan Africa company enter into the region. And for Move, they're talking about, I think, the 13th round, 14th round of financing. They've consistently had to raise more capital because it's very intensive when you're doing asset financing and you're not a bank, right? So I'm just curious for Shift, are they going to go down this direction? Because then, it almost prices out VC investors. You're sitting so low on the capital stack, you have no idea if you will ever get paid. If the company has any chance of stalling and not getting to that later liquidity. But anyway, I think it's not unusual to expand into multiple sectors, at least to try. And worst case, they will focus on something else again by the next round.
Scale down. Tambi, what do you think about focusing on one or two services versus experimenting with so many other services?
It depends if they're experimenting or is it part of the backbone of their revenue streams. So it seems as if they're doing everything at the same time. I didn't feel that they're experimenting as Shift. Feels that they've grown, they have certain kind of command on certain routes or ways of delivering that service to people that Kareem even can't compete with. I'm assuming, looking at the size of the round, the revenues are high, but I don't understand mobility, and I'm not sure how they will grow, if they will grow that fast. I don't know if that's the aim. This feels like an IPO play that Mirak will help them fix their books and everything and look better and then take them public. Saudi IPOs are the new SPACs. So I think it's a good approach for Mirak, and good luck in that.
Aboudi, you spoke passionately about this company. Let me ask you this. So where do you think they can grow from here? With this big ground, and as Faisal said, it seems that they own their fleet, and it seems there is overlapping between their services, car rental, and then you can take a car like Zipcar in the US. What do you think?
I think first and foremost, it's clear that none of us really know the details, right? It's a good assumption on Faisal's part that they own the fleet, but to be honest, we have no idea. I agree with Tambi that it doesn't seem like they're experimenting given the fact that they're operational in 57 cities already, right? These are the small things we already know. So for me, one of the things I always tell founders when it comes to product development is you can build out this whole idea of what your product is now and where you're going to go, or you can do one thing very well, listen to your customers, and then build out secondary and tertiary products from there. That's typically how I like to see things done. That said, and this goes back to what Mark was saying, there's very clearly an enormous opportunity given the lack of actual existing solutions in the market. So I would assume that the founder, and again, this is based on the very limited information I have, but I would assume the founder realized that there's no all-encompassing solution for mobility in the region and decided to launch a fully fledged, let's say, super mobility product. I'm, again, typically very against people coming and approaching and having like a huge vision at first without actually doing something very well. I think it's the most dangerous game in VC. But if we take a step back and look at this objectively, it's very clear, at least from the press release, that it's working, right? If you're operational in 57 cities and you have solutions in cross-border mobility, in delivery of goods, in chauffeur services, in partnering with the likes of Amazon and doing company car rides, there's clearly something that's working very well there. Now, in terms of where they can go from here, again, typically I would say you need to prove your ability to plug and play your solution in multiple markets. I don't think that's the play here. I think it's very clear that this can be a Saudi-focused company for now and can continue to deliver on mobility. But like I said when I first spoke about it, there's so much more than mobility at stake here. If you really are controlling the flow of goods and the flow of people, the data play is enormous. It's enormous. And that goes and ties back into Saudi 2030 vision, right? If you've got a company that knows where everyone is going and where every single good is going, route optimization, traffic optimization, I mean, there's so many things you can do with that I think remove the need to expand internationally.
Jamie, let's move from mobility to EdTech now. What's happening in that space?
Yeah, a pretty kind of unusual, not unusual, but I think unusual in the region with regard to EdTech, that it's very industry specific on the telecommunications side of things even. So you've LabLabE, they're an Algerian startup, so they specialize in training for workers in networking, telco, 5G technology. So they've raised a $3.4 million seed funding round. So that was led by Reach Capital, other participants, Classera, Bright Eye Ventures, Ian Capital, etc. So they intend to use the funding as well to expand to the US, which I thought was quite interesting, as well as strengthening their leadership in Europe. I think they also are based in France as well as the MENA region. So the company itself was founded in 2021. So I suppose unlike other sort of, I guess you call it MOOC, massive open source or open course kind of platforms like Coursera, Udemy, it's very focused. So explicitly on, as I mentioned, telco, 5G, cloud computing, Internet of Things. So they offer sort of immersive labs alongside theoretical training. So they partner with companies like Juniper, Wind River, Amarisoft, and they collaborate with a lot of telco operators as well as universities. So very kind of customizable training courses. They cover like Kubernetes, OpenStack, cloud native technologies, etc. So I guess the goal is, or what they're trying to tap into, it seems, is obviously a sort of skills gap as telco kind of undergoes that paradigm shift to cloud native technologies. So they're hoping to sort of assist or support with the kind of AI integration into that space and whole reskilling of the workforce as that takes place.
Thank you, Jamie. In general, I think it's really hard to target big corporations or large enterprises, especially if you're a small company. And add to that, you're in the EdTech or training sector. So focusing on that niche, you have to have the connections in those companies, right? To start offering them. The sales cycle is very long. So in general, are you with going very niche, targeting big companies, or going wide and targeting smaller companies? I'll start with Tambi. You're the seed stage person here.
I'm also an investor in Labi, by the way. Angel.
Okay, nice.
Oh.
Angel, as an angel.
Yeah. So back in 21. I love the guys, and I really believe in their mission. Jamie, by the way, I can't add anything to what they're doing. You said it perfectly. And it's a discussion, by the way, that we had a few months ago, like really, because sales cycles do take long, but at the end, the employers, most of the employers, so they do have an approach where they want to offer more way for people to get training before they even get employed. But most of the time, the buyers are the people, the enterprises, the telcos that are recruiting these hundreds of thousands of people, by the way. It's a huge market. There's a whole industry of retraining engineers, by the way, that I didn't know before I did the investment. Like every time there's a 4 to 5G, for example, or pre-Open RAN to Open RAN, which is currently what everyone is using, there's a huge amount of, I'm not going to say waste, but opportunity for Labi and others like it to actually train those people while they sit in virtual labs, in virtualized environments, like they can run the whole stack on the machine or the cloud for that student. Anyways, I don't want to over talk about them because it's a portfolio company, but yeah, that's what I think about them.
Okay, Tambi. So they have very impressive customers. Like they have Ooredoo, Etisalat, and T-Mobile in the US, and now they're trying to focus more on expanding in the US market. Can you tell us more about this strategy? Why the US specifically, and how are they going to tackle that big market?
Because that's where a lot of spend on telcos is happening, by the way. So regardless of, if you look at it, that the GCC might have a different spending behavior for the average consumer, but telco number of points or people employed in the telco industry, the US US, Mexico, even Latin America are huge, by the way. So I think it is the right move for them as an Algerian company. And this is led by Reach Capital, which is a good investor. They also did Replit. So they understand EdTech and they're betting on that. And hopefully with their connections, they will be able to do it. Anyways, I'm going to leave the room for others' opinions.
Tambi won't talk so well about his portfolio company. He's being too humble, because for me, I think whenever I see a story like this, I think like, wow, this is such a good example of something actually working, despite every indicator suggesting this would not be easy for any African or Middle Eastern business, especially an Algerian business, especially in EdTech, especially at this time. It's one of those, stories of like a plant growing from a road of cement. It's so unlikely that it's fascinating to see. I think for me, when I even saw first the funding rounds, the first reaction I would say is I would just write to all my Algerian friends and say congratulations, because it's not, even if they're not related to the story, it's one of those stories that gets people thinking, okay, maybe something is possible. I think for maybe some of you might be familiar, some maybe less, is that Algeria is a very challenging market for startups and VCs. You can't even compare it to Morocco or to, say, for example, Tunisia, with the exception of Yassir, which was a very, very rare, unnatural and unusual success story. You see very few funding rounds. You see very few venture funds involved. Even African funds are quite careful about investing in Algeria. And the idea of seeing French funds, American funds, corporate funds, Middle Eastern funds all coming together, this is like at least to my knowledge, like a near once in a lifetime story to date. And hopefully it will change, of course. I think it's quite interesting the way that they're targeting their positioning. The idea of selling to a big customer when you are an African company is almost natural. Because if you think about it, as you compare a Saudi customer, a typical Saudi consumer, as compared to an Algerian consumer or Moroccan consumer, the spending power is 10 times larger. So targeting a mass market in a market where the spending power is very low, it's actually not a good venture-backed strategy. You see a lot of African companies with millions or tens of millions of customers, and their margins are low, their volumes are high, but their actual profitability is limited. So they really need to be covering country-size scale to get to revenues of millions of dollars. For these guys, it's a very different position, right? You need your Verizons, you need your AT&Ts, you need your Oranges, and then you are sorted. So I think actually what they're doing...
Mark, you also need a lot of capital to sustain yourself enough until you close those customers, right?
Of course, it's a very long sales journey, but I mean, if anyone's going to do it, it will be a 500 global alumni with, you know, seed capital, pre-seed capital from the same investors. I think, Tambi, actually, a question to you. I think it was some consistency, right? There were the same or similar investors in the pre-seed and seed round, Bright Eye, and they're participating across rounds?
Bright Eye did. Kima, I'm not sure.
But what about Ian, right? Etisalat, they are taking part across rounds as well?
No, I'm not sure. I don't know if I can disclose this, actually.
But yeah, I guess like my point is that it's usually as a VC
They've been
fund.
supportive.
Yeah. I would say as a VC fund, when you take a increased position on a startup, right? You're basically saying to everyone that I'm comfortable paying a higher price than I paid before because I think the potential is still the same, if not even bigger, right? So it's the best signal I can imagine when a company is doing well that the VC fund says, I will follow on this investment. And if they have 2 or more funds following on, I think it's a healthy sign. So yes, I agree, Ahmad, it will take a lot of capital. And I think more importantly, it will take a lot of patience, which is preciously more rare than even capital in the VC back game. But if they have the patience and they take the time, I think it will be a good strategy to expand to the US. And also, I think they're doing a bit of thinking about Latin America as well, which is also a good market to do this in. I don't think there'll be much competition there either.
Admittedly, I'm probably the last person to ask for an opinion on EdTech companies. I really have very little experience in them. I would say my experience is probably from the user end. I work in a large corporation. I can tell you that on a corporate education level, even in digital format, it is absolutely broken. So anything that can make it better, I think has a very good chance at succeeding. And then the other viewpoint, as a parent with 2 kids attending school, I can tell you this is it's a continuously evolving landscape. And you know, the obvious rhetorical answer is technology is taking over. From the corporate end, I think the incentive is to push out the cost of education and training from the companies onto the employees. And from, you know, a parent-school kind of relationship education viewpoint, it's about making it more accessible, more, I want to say, independent of the physical presence inside the schools themselves. Now, on the concentration, I think there is a reason why they call it concentration risk. It's not a good thing in general. But if you're a young company and by some miracle are able to shorten your sales cycle and secure and lock in a big client, that almost makes you, you know, indestructible, because you become very difficult to kill as a young business. But yes, that is only transitional. You cannot continue being or only serving large clients. You absolutely have to diversify and de-risk that concentration.
Aboudi.
So I want to preface this by saying if there's one individual in the region who I think knows software, it's Tambi. So his angel ticket in the startup would signal, obviously, that they know what they're doing and they have a foundational tech. But I will also say that I really, really don't like EdTech. Obviously, I love education and I think it's so important. And I think, you know, I come from a family that promoted a lot of education in Palestine, not to, you know, preface the next topic we're going to speak about. But I think EdTech is the most difficult space in the world to scale and to do well and to be profitable in. I think founders that operate in EdTech deserve an extra, you know, crown because of how difficult it is. And I'll give a couple of reasons why. First and foremost, I think there's always a new trend that people want to learn. A couple of years ago, it was coding, then it was blockchain, now it's AI. Who knows what's going to be in you know, 2, 3, 4 years. And so to maintain an edge in the education of new technologies is inherently difficult. That's number one. 2, I don't know of any global EdTech companies that are genuinely profitable, right? You have the Coursera's of the world and stuff like that. But in terms of really achieving scale and doing so in a profitable manner, I'm not familiar with very many. I think it's a very difficult thing to do. I also think creating repeat users in EdTech is extremely difficult. When it comes to fintech, I'm going to be, if I'm a regular user, I'm going to be using a PFM, a personal finance management app, on a daily basis. I'm going to be applying for consumer loans quite regularly. These things are things that I will do over and over again. But, the 5 of us or 6 of us sitting on this call, we have jobs, we have, our health, we have families, all these things. And to also invest on a regular basis in self-learning and self-development through your corporate, it's a hard ask. It's a very difficult ask. So as much as I love education, I think education is also free right now. This podcast is a form of education. There are very few things that I can't go and find out for myself for free online at the moment, right? And those things are always changing, like I said. So as much as I read, startups and EdTech receiving funding, and it makes me happy inside as an investor, I don't think I could ever invest in an EdTech business, honestly.
Just add more insight. Thanks, Aboudi. By the way, you're correct, and I don't even like tech, but the guys at Leblib are not pure tech because Samir, his background is he worked in Mavenir, which is virtualization software for telco stacks. And the virtual lab element is their, I would say, IP and unique offering, rather than curriculums and competing with teachers, which is usually what happens in EdTech, where you're trying to compete with the government. But here, those software parts are what's interesting in Leblebi. So you're correct in your assumption.
But I think what you just said is a very important thing, right? At the end of the day, when you're investing in pre-seed or seed, you're investing in people. People can say you're investing in traction, opportunity, market. It's all BS. You're investing in people. So if you have conviction in their ability to scale the business, then I can't argue that.
Let's see what happens.
Jamie, take us to the next story. I'm super excited about this one because it's about Palestine. Let's see.
Yeah, a rare bit of good news in the current climate. So EdTech Fund, they've successfully closed their second VC fund, so EdTech Fund 2. So 25 million, so that surpassed the initial target, I believe it was 15 million, and it's also doubling the size of their first fund that they had as well. So in terms of the backers, you have the European Bank for Reconstruction and Development. They've invested 3 million. It's also, I think, their first equity investment in a VC fund in the West Bank ever. You also have Bank of Palestine, the Dutch Good Growth Fund, and the IFC as well. So in terms of investments from the fund to date, you have companies like DataQ, Mental, and Vatrin. So their fund as well retains the flexibility, just to mention, to invest in companies from neighboring regions as well that are connected to the West Bank and Gaza. So look, the goal ultimately, address capital shortages and economic challenges faced by tech startups at the moment. And to tie in with that as well, to mention a story from a couple of weeks back too. So Intersect, the Ramallah-based tech hub and incubator, so they also announced, I think it was maybe 2 or 3 weeks ago now at this stage, the first close of a 5 million bridge financing facility as well. So that's going to help to extend the runway of Palestinian tech startups that are obviously impacted by the ongoing war. So it's known as Safe Palestine. So it's going to immediately provide needed liquidity to 29 different high-growth Palestinian startups, and is going to help to preserve over 300 existing jobs, as well as creating new employment opportunities as well. A rare bright spot in a pretty dismal time.
Yeah, finally some good news from there. Let me start with Safe Palestine. Their 5 million bridge financing facility was designed to help startups overcome disruptions caused by the ongoing genocide, let me say, not just war. How do you see Palestinian startups innovating while facing this brutal occupation? And what role does VCs in the region can play in maintaining this resiliency?
Man, it's like the most difficult question in the world to answer, because ultimately we can sit here and talk about VC's role in maintaining resilience, but we don't know what it's like, what they're going through, especially as a Palestinian myself, who's only ever been there once because of the situation. So I think as much as I welcome, Safe Palestine and all these wonderful initiatives, I think we have to step away from the VC angle for a little bit. And as Arabs, all of us just be as readily available to help Palestinian startups as much as we can. Because we can sit here and pretend maybe these funds will go and they'll help them scale. But truthfully, anything, if I don't want to get too political, but we all know that if Israel were to see Palestinian startups thriving, they would find a way to shut it down. honestly. That's my inherent belief. And with that in mind, that's why I want to take a non-business perspective to this and just say I think all of our obligations now are to try and support and mentor and be there for Palestinian founders as much as we can. Obviously, maybe try and help them establish market presence in other markets so they can truthfully scale. But we've seen Israel act with impunity for 11 months now, not only in Palestine, right? In Lebanon, Syria, Yemen. So I don't want to have like a non-optimistic view about this. Everything I do in my life is to try and create a better awareness and opportunity around Palestine. But for me, it's like, you know, we can sit here and say as VCs, we're resilient, we go through adversity. We don't know shit compared to what they're going through. And so for us, we just need to be there as mentors, as friends, as brothers, as husbands, wives, whatever it is. And whenever we have an opportunity to try and make a difference for a Palestinian founder, like we should all drop what we're doing to do that.
Faisal, Tambi,
No,
Mark.
I wholeheartedly agree with what Aboudi said. I think on one end, we cannot be dismissive of this news. This is actually excellent, beautiful news. We need more of it. We need to amplify it. We need to make it known. But at the same time, it's quite lofty of us to say, you know, this is transformative. It's not. I mean, like Aboudi mentioned, I think the pain that the Palestinians are going through inside Palestine is much more rudimentary. It really does cut literally to the bone. So, I mean, having this announcement at this time is beautiful, but what they're going through is much more life-threatening than announcing a new fund for Palestinian companies.
Nothing to add from my end. I would just hope that life becomes better for Palestinians before the end of this fund's lifetime, and they get to really grow companies and use that capital. And congrats to the managing partners.
Yeah, I mean, I think at the risk of trying to not offend any of our viewers or listeners, I think the one thing that most people have to remember is that as VC is not the solution for most social questions, right? VC is a very, very, very small, incremental, micro part of financial services. And I think that even shows in the question of the EdTech announcement, right? I think, Jamie, you were just sharing who were the investors in the fund, and I was listening to it, and it sounds like the investors in like a 2005 Africa fund, Dutch Good Growth Fund. Okay, that's a Dutch DFI. IFC, that's the global DFI. Who else did you say? Bank of Palestine? Well, the Bank of Palestine didn't support. EBRD. Okay, right. I'm from Eastern Europe. EBRD coming in usually doesn't mean that everything is going well. It means that they think everything is going so badly that it's so cheap that there is going to be opportunity for someone to come in and redevelop, right? EBRD was most active after the Soviet Union collapsed, right? So I think, unfortunately, I think like it's small wins and it's a good sign, as you said, but it's, I think this should be maybe seen in isolation, the news of this, and it can be celebrated in isolation, not as a solution or in any way a salvation story, but as just proof that the broader narrative that the Palestinian economy doesn't exist is wrong. I think one thing that is applicable in Palestine as much as in the Congo, as much as in many other markets, is that the economy is driven by small business. I don't know, Aboudi, I haven't been to Palestine, but I would imagine it's upwards of 90% of business, maybe 95, 99% of business is probably small business. And small business needs SME financing, and it needs venture capital early stage to prove that it can scale to big business, right? That's what we saw in like the first 20 years of the African VC space, which is really just 15, 20 years old, right? So I think in that sense, if EdTech fund can be an example, and then other funds in the region can actually build commercially successful models, that's great. And I think what I saw that was positive in this announcement was it wasn't just IFC and Bank of Palestine, because if that was the case, I would feel very sad. I would think that the people are basically saying no one commercially believes in it. But I heard, at least on the announcement, there were some private investors involved, some corporate investors involved. So there's some people who believe in the commercial appeal of investing, both in the region and in the people, which I think is very valuable.
I think you articulated that extremely well. If I can just say, I think that's exactly how to look at it, right? Celebrate it in isolation. Don't let it distract from everything else that's going on there. The one thing I think we all know is that in the darkest times, resilience is bred and born, and there will absolutely be some people that, you know, manage to survive everything that's going on and come out with an even stronger internal core and resilience, and maybe those people will go on to be great founders. But ultimately, like as you said, there are other things to focus on along with this announcement, right? And it's not just, okay, this is great news and let's celebrate this. It's like, this is a good start, baby steps, but there's so much more that needs to be done.
Yeah. So Mark, you mentioned the need to focus on SMEs, but let me push back a little bit and maybe ask the question in a forward-looking way. Epticar Fund said they want to focus on tech companies like AI, e-commerce, fintech, etc. What advice can we have for both Epticar Fund and for startups, tech entrepreneurs in Palestine to be able to compete regionally or globally in those specific sectors?
I mean, I think number one, it's that the cost of starting a business has decreased a lot, right? If you think about it, the cost to build, for example, a website business, right? It's maybe a website builder. It's gone from maybe $10,000 in 2000 to what, $50 now? Like what prevents us, just the room here today, from saying, okay, we're going to build a website builder. Let's quickly whip up something on a no-code solution, run it live, and there we go. We have our business. Then Aboudi gives us the business model. Faisal gives us the connections. Tambi gives us the tech knowledge. I don't know what I give us, maybe the nice face. And then there we go.
Very humble of you.
Right, but my point, I know. I give the glasses so that we all look very smart. But I think the biggest thing, jokes aside, is that I think obviously it's very challenging, probably number one most challenging country in the world to build a small business in right now, for mostly non-business reasons, as we've established. But what does that mean? That means that at least probably wave one of founders will have to be selling outside of Palestine. Are they selling to Saudi customers, to Emirati customers? Are they selling to European customers? Are they selling somewhere else? In that sense, I think even you see success stories from small ecosystems. Usually, tier one or stage one is you sell abroad, and stage two, you then bring that abroad experience to convince local businesses to buy your solution as well. I think at the moment it will have to be mostly abroad just to protect those businesses, protect their revenues, and ensure they're sustainable. And I think what I thought was interesting was the Epticar announcement that they can fund also founders who are not necessarily in Palestine, but who are building something for the region, maybe from outside. Maybe they're sitting in the UAE, maybe they're sitting in America, maybe they're sitting somewhere else. And then they're building something for the region with their personal safety guaranteed as well.
Tambi, what advice do you have for early stage companies in Palestine focusing on tech sectors like AI, e-commerce, fintech?
Similar to what Mark said, get customers from outside of Palestine. Customers, hire the team, use the network within Palestine. But of course, even Egypt, which has different dynamics, also need to de-risk their revenues by actually getting customers from outside of Egypt. So for sure, this advice would be 10 times more important in Palestine. And use the connections. Use a lot of people care about you and want to give you extra time. So use that, which I think a lot of people use, but maybe they shy a little bit. I would urge them to just reach out some more and get those contracts from across the region and the globe.
Aboudi?
I mean, I'm sorry we can't do more, first and foremost. Obviously, we as investors that don't necessarily focus on Palestine. I agree with the advice of trying to establish markets or presence elsewhere. But I also just don't think it's that simple, right? At the end of the day, it's hard enough doing business in Jordan and then trying to go to Egypt, or in Saudi and then trying to go to UAE. Our region is as exciting as it is, and as much as I'm bullish on, we make it difficult even in the most established markets. So as much as I agree in principle with the advice that's given, and that's the same thing I would have said if I answer first, I then hear it and I realize how ridiculous it sounds, because how can we tell them to establish a presence outside when they don't even know what the next day holds? That said, that is the best advice, right? It's a very different situation, but we had a company that you guys spoke about on a recent episode, which is based in Pakistan, that was doing exceptionally well, called PostX. But in order to unlock, presence and growth elsewhere, they need to operate in Saudi and the UAE. And they've done that. And now they're getting investor interest and customer interest. And so when you establish yourself in markets that people are more familiar with, obviously things tend to go better for you. So it's the same kind of example where it's like maybe Pakistan was, even though the company was as you guys, I mean, it's in the TechCrunch article, they were doing 21 million bucks in ARR, expected to do 25 by the end of the year. It's an exceptional company, but only until they establish themselves in the UAE and Saudi is there going to be this general excitement that has now happened since they set up in the UAE and Saudi. So it's very similar for companies in Palestine. You know, I'm sure you can build something exciting there, but until you're off the ground somewhere else, there probably won't be as much external interest. And that's pretty, excuse my language, that's pretty fucked up, right? But that's the reality of it.
Faisal, any advice?
No, I agree with the gents. I mean, this is definitely the definition of pedestal advice. You know, we need to get off our pedestals and stop, you know, telling people theoretically, even if you're in Palestine, you can still do business elsewhere. It's not the case. Even more so in industries that I'm familiar with, it's almost impossible if you're in the financial services industry to do cross-border business without being in that geography because of regulation and compliance requirements. That said, yes, technology, generally speaking, deshackles you from the physical assets that are governing other types of businesses. So that's a good thing. My simple advice would be, if you are a Palestinian founder, we're talking about Palestine, it's probably better off, given the situation, even, you know, in the absence of a genocide and the continuous occupation and aggression, it's a small market. I mean, by design, you wouldn't want to operate only in Palestine. Even, I would argue, you probably wouldn't want to operate first in Palestine. If anything, you know, the silver lining here would be, there are a lot of people, us included, I want to say, who are compassionate with what the Palestinians and Palestinian diaspora are going through. So yes, we would want to give them an advantage, put them at a vantage point and a helping hand to help them operate elsewhere. I say that quite openly. I mean, I would be extremely biased if I'm put in front, you know, a company that has a Palestinian founder, especially now, talking out of emotion. I would say I would be more likely to back them than anyone else.
Agreed.
Well, great. With that, let me end with this. As Palestine's tech scene keeps growing, it's great to see local resilience paired with international support driving innovation forward against all odds, against the international lack of action to stop Israel from committing more war crimes in the state of Palestine. With efforts like Ibtikar Fund and Save Palestine, we're seeing real potential and real hope for Palestinian startups to shine both regionally and globally. With that, thank you so much, Aboudi, Mark, Tambi, and Faisal. And as always, thank you, Jamie, for getting us all this news.
Thank you, guys.